Welcome to this explainer. Today, we're going to demystify wealth building and prove something that honestly might just change your life. Look, what if I told you that the difference between someone who retires wealthy and someone who doesn't isn't actually about how much money they make at their 9 to 5. It's simply what they did with the very first $100 they ever invested. Stick with me here, because by the end of this explainer, you're going to know exactly what to do with that $100 and why starting today matters way more than you've ever been told.
All right, let's dive right in and tackle the biggest myth most people believe about investing. It usually sounds a little something like this: I just don't have enough money to invest. And hey, it's completely understandable why people think that, right? I mean, when most of us hear the word investing, we immediately picture Wall Street guys in expensive suits moving millions of dollars around. But here's the truth. You don't need Wall Street money to start. You literally just need $100. We're not talking about some shady get-rich-quick scheme. We're talking about a real, proven strategy that everyday people, teachers, delivery drivers, nurses, college students are using to build actual wealth. Okay, the math here is absolutely mind-blowing. Check this out. If you invest just $100 a month, starting at age 25, and the market returns a conservative 7% per year, by the time you hit 65, you'd have over $260,000. Let me just repeat that. $100 a month at a 7% return from age 25 equals a whopping $260,000 by age 65. But if you wait until you're 35 to start, that exact same $100 a month drops your ending balance to just around $121,000. This massive difference is all thanks to what Albert Einstein reportedly called the eighth wonder of the world: compound interest. Basically, your money earns returns, and then those returns earn returns. It just snowballs. So, here's the really painful reality of this math. Waiting just 10 years to start investing literally costs you nearly $140,000 in lost growth. Think about that. Just 10 years of waiting and you're missing out on an absolute fortune. The core lesson here is super simple. The best time to invest was yesterday, but the second best time? It's right now, even if you literally only have that first $100.
So let's get into Section 1, 4 beginner investment options.
Let's kick things off with option 1, index funds or ETFs. This right here is the Warren Buffett-approved beginner move. An index fund is basically just a basket of stocks that tracks the entire market. Take the S&P 500, for example. It includes the 500 biggest companies in America. Apple, Amazon, Google, you get to own a tiny, tiny piece of all of them. And historically, the S&P 500 average annual return is right around 10%. Because you're spreading your money out across hundreds of companies, your risk is way lower than if you were just guessing on one single stock. Plus, apps like Fidelity, Schwab, and Vanguard let you start with as little as $1. Zero minimums, which means zero excuses, right?
Which perfectly leads us into option 2, fractional shares. Guys, this one is an absolute game changer for beginners. Let's say you really love Apple stock, right? But a single share costs over $200, and you just don't have that sitting around. Well, no problem. With fractional shares, you can buy just $25 worth of Apple. You essentially own a slice of a share, and your money still grows as the stock grows. Platforms like Robinhood, Public, and Fidelity all offer this, and it has completely opened the door for first-time investors to own pieces of major expensive companies without needing massive upfront cash. Now, option 3 is where things get really exciting. Enter the Roth IRA. A Roth IRA is a retirement account with a literal superpower. Your money grows completely tax-free. Seriously, you put in $100 today, let's say it grows to $500 over 20 years, and when you take it out in retirement, you pay $0 in taxes on that growth. None. You can open one of these with most brokerages with zero minimum deposit. And for 2024, if you're under 50 and have earned income, you can contribute up to $7,000 a year. This is genuinely one of the most powerful wealth-building tools on the planet, yet so many people haven't even heard of it. Finally, we have option 4, a high-yield savings account. Now, okay, this isn't technically investing in the stock market, but if you're feeling a little nervous about the market, this is exactly where you should start. Regular, traditional bank savings accounts pay a measly 0.01% interest. It's practically nothing. But high-yield savings accounts at online banks, they can pay 4 to 5%. That is literally 400 times more interest. It's not going to make you rich overnight, for sure, but it absolutely beats letting your money sit doing nothing. Plus, it keeps your cash liquid, meaning you can access it anytime. It's just a perfect, safe space to earn returns while you're building up your investing confidence.
Moving on to Section 2, beginner mistakes to avoid.
The absolutely crucial point here is knowing the difference between a beginner mistake and a pro move. Mistake number one, trying to time the market by waiting for a dip to invest. The problem is nobody, not even the Wall Street pros, knows when the market is going to dip. The pro move here is dollar cost averaging. That just means investing the exact same amount every month, no matter what, which evens out your purchase price over time. Mistake number two is picking volatile individual stocks too early, where one bad earnings report could mean a 20% drop overnight. Ouch. The pro move? Sticking to those broad index funds we talked about until you have a solid foundation. And mistake number three? Obsessing and checking your portfolio every single day. Seeing those daily changes just leads to emotional decisions like panic selling. The pro move is to set it, let it grow, and maybe check it monthly at most.
But hey, before you do any of that, we have to talk about the most critical mistake to avoid, which is investing before you have a safety net. This is an absolute necessity. Before you put a single dollar into the market, make sure you have at least 1 to 3 months of living expenses saved up in a liquid account, like that high-yield savings account we just looked at. Why does this matter so much? Because life happens. If your car breaks down and you suddenly need cash, you do not want to be forced to panic sell your investments at a loss just to cover a repair bill. Always protect your investments by building an emergency fund first. All right, let's get practical with Section 3, your exact action plan. Okay, here are your exact 5 steps to get started today. Step 1, open a brokerage account. Places like Fidelity or Schwab are fantastic for beginners. There are no minimums, no fees on most trades, and honestly, it takes about 10 minutes to set up online. Step 2, deposit your $100 and immediately set up an automatic monthly transfer. Even if it's just $25 or $50 moving forward, automating it completely removes the temptation to spend it. Step 3, buy a simple index fund. Look at ETFs like VOO from Vanguard or FXAIX at Fidelity. These track the S&P 500, have extremely low fees, and they're exactly what Warren Buffett recommends. Step 4, if you qualify, open a Roth IRA and do this investing inside of it, so all that money grows tax-free. And Step 5, don't touch it. Seriously, just let compound interest do its long-term work. We aren't trying to get rich in a year, we are building wealth over a lifetime.
If you take away anything from this explainer today, please let it be this core truth. Building wealth isn't about being lucky. It's not about having a massive salary or knowing some top-secret Wall Street hack. It's simply about starting with what you have. Every single millionaire investor started somewhere, right? And most of them started exactly where you are right now. Curious, maybe a little nervous, wondering if it's even possible? Well, I'm here to tell you, it absolutely is.
So I want to leave you with this challenge. What are you going to do with your next $100? This week, make a decision that your future self will thank you for. Go open that account and invest that first $100. And hey, if you found this explainer helpful, share it with a friend or a coworker who keeps saying they'll start investing someday. Remind them that someday is today. Coming up next, we're going to break down exactly what to do once your investment account hits $1,000. Because, spoiler alert, the strategy definitely changes. You are not going to want to miss that one. See you then.